Hello, everybody, and welcome to Mike Norman Economics. My guest today is a Sam Harris Professor of Law, Corporate Finance, and Securities Law at Yale University. His name is Jonathan R. Macey. He's also author of a new book entitled The Death of Corporate Reputation, How Integrity Has Been Destroyed on Wall Street. Jonathan, thank you very much for coming on the show. I appreciate it.
It's great to be here. Thanks.
My first question is, has Wall Street ever had any integrity? I mean, you can go back in the last century, even before that. You had people like Jay Gould, Jim Fisk. You had scandals in the 20th century. You know, I mean, isn't this the way Wall Street operates?
Well, that's a great question and a very valid question. My view is that there certainly have always been crooks on Wall Street, and that there always have been problems, and that's why the Securities and Exchange Commission was created by Franklin Roosevelt, and they put in Joseph Kennedy, and Roosevelt said, "I want this guy to be head of the SEC because he knows all the crooked tricks and because he's done them."
Yeah, he certainly did.
But the difference between then and now is that the people who were engaged in the sort of edgy shenanigans and the sharp dealing were considered to be outliers, and that they were breaking with the norm and the tradition of honesty and integrity. Whereas now it seems to be standard operating procedure. Or the way I put it, it used to be when a upper middle class a person who's coming into Wall Street to make some investments and trust a broker with their money, they were considered to be a customer. And the business model was to treat that customer well, and that the customer and the firm would their fates would sort of be tied together. One did well, the other one did well. We don't have customers anymore. We have counterparties in trades, and you never know whether...
Like the old commercial, my broker's E.F. Hutton, and what E.F. Hutton says,
exactly.
We all have to listen in, or Merrill Lynch, bullish on America. So you're saying that Wall Street now, and can you date this for us? Because you're saying now, but when
Right.
is now? I mean, if I look at it, I kind of think this all started maybe 30 years ago with the beginnings of a lot of deregulation in the financial industry. I mean, this took away, or at least incentivized, a lot of these sort of dealings that we're seeing right now, the customer as counterparty and no longer that relationship. When you say now, are you talking about that period in time?
Yeah, I think the real watershed event was the Gibson greeting card and Procter & Gamble scandals involving swap transactions, that those sort of Main Street, well-respected U.S. companies did with Bankers Trust Company. And basically, in those transactions, Bankers Trust, to use the familiar vernacular, ripped these clients' faces off. And these swaps were basically a heads, Bankers Trust wins, tails, Gibson greeting cards, or Procter & Gamble loses. And this became very famous. Bankers Trust made a lot of money. Of course, these companies sued Bankers Trust. Bankers Trust did very well in the lawsuits, but its reputation couldn't survive. And ultimately, the CEO departed. The firm was taken over by Deutsche Bank, and the name is gone. Same thing with Salomon Brothers. So in other words, there was a time, maybe 30 years ago is probably about right, when a firm that got a reputation for ripping off its customers and engaging in kind of sharp practices could not survive because nobody would do business with it. Now, after this, something
That's
has
the only way they could survive now. If you look at Goldman,
right.
I mean, it looks at its customers purely as a counterparty. We saw the whole entire affair with the selling of with the mortgage-backed securities, where they created that instrument that was designed to blow up for John Paulson,
Right.
right? And then they went out and they sold that as a AAA rated, pristine security when they knew very well. And in fact, they even shorted it. They knew it was going to blow up, all right? So there was absolutely no regard for the counterparty customer or client in that situation, and they admitted to that. But one of the things you say in the book is that it's not so much about regulation. I think you're saying we try to over-regulate when we really should be looking at reputation. But isn't this just kind of human nature? I mean, when you have so much money at stake, human nature is that some people, some firms maybe are going to try to cut corners. They're going to try to grab that money in any way they possibly can. In other words, they're going to be unscrupulous. Don't we need the regulation?
In theory, I'm a huge fan of regulation. I think regulation is great. We ought to regulate everything. The problem is regulation doesn't work in practice. It works horribly. And one of the main points I make in this book about regulation is I think a little bit new. It may not be, I'd be interested in your view of it, which is that when somebody goes into a financial transaction, say the Abacus trades that you were talking about that involved John Paulson and Goldman on one side and a couple of not insignificant German financial institutions on the other side, these people, if they're rational, they have to think that they're not going to be completely screwed and ripped off in these trades, okay? And there are only three ways somebody can really have confidence that they're not going to get ripped off in a trade. One is there can be a regulatory system that works to protect people. The SEC, you go to the website, we're the investor protection guys, and we have regulations, but it doesn't really protect anybody. And it's a kind of a trap for the unwary. The SEC, to get a budget, has to say they're protecting investors. Nobody who came within 500 miles of the Bernie Madoff scandal, Mike, can say that the SEC is protecting people. The second way that somebody can be protected is if they themselves are so sophisticated that they can understand every nuance of the transaction and assess the risk for themselves. And the third is if they think their counterparty has their best interest in heart, is a fiduciary, and isn't going to rip them off. Now, the problem is all of these things are substitutes for each other. So if I think that regulation really works, then I'll go and do business with a Bernie Madoff or a Goldman Sachs or a Bank of America. I'll take out these people who are, we're talking about the capital market side. There's also the supply side, the guys who go in to get a mortgage to buy a house. They think this broker, this mortgage broker, is going to not rip them off, and these guys got horribly ripped off.
So you're saying it's better to maybe have no regulation, put the caveat emptor, right? Put the onus on the buyer or the investor who knows nobody's out there to protect them. There's not an SEC. There's not some, the goodwill of the firm looking out for their interests. So they have to do their own due diligence. It's better to have no regulation?
No, that's not what I'm saying. I certainly think people need to do their own due diligence. My real problem is not so much with regulation, although I'm not a fan of regulation because I don't think it works. My problem, Mike, is with the idea that we have regulation and people actually think it's going to protect them. So my ideal situation is we have regulation to protect investors, but people do not indulge in the fantasy that we've seen disproven time and time again that this regulation is going to protect them. People are going to get ripped off. In that way, I mean, the Bernie Madoff thing was one of the greatest tragedies in finance because of all these wonderful philanthropic institutions and people who got ripped off. But Bernie Madoff has done more for investor education in this country than the SEC has done in 65, 70 years. Because you look at that, and if you're a rational person, it seems to me you can't help but think this is people need to be careful, and they need to think about reputation. If you think you're being protected by regulation, you don't care about the reputation of your counterparty.
The SEC clearly wasn't there. The cop was not on the beat. But can you name some names? I mean, who are the most egregious firms? Clearly Goldman Sachs has got to be one of them. Maybe J.P. Morgan under Jamie Dimon's leadership. Who are the worst out there right now? Can you name some names?
Sure. I mean, there's no question that the worst. I mean, so the worst in my view, with respect to reputation, sort of how do one put abusing historic reputation, would be the credit rating agencies, Standard & Poor's and Moody's. That it used to, you're an economist.
I used to work for Standard. I actually got fired for writing a negative article on General Motors in 2000 when the stock was at an all-time high, and and the guy who's still there, their chief auto analyst, Scott Sprinzen, and I'll mention his name, he's still over there, and that's the guy I had the run-in with. But anyway, they're the worst.
So let's talk a little bit about the economics of these credit rating agencies. So the business model in the good old days, I'll call them, was if I'm a business, I'm in a company issuing securities, I'll pay $250,000 to S&P or Moody's to rate my securities. Why would a rational business do that? Why would they spend this $250,000? It has to be that when they go to raise capital, they will save more than $250,000 in capital costs, interest payments, because they have this fancy rating. But if nobody believes the ratings, then the whole business model tumbles. And so in at least historically, the credit rating agency business was a reputation business. Solely, the economic model depended critically on the reputation of these credit rating agencies. Now, no, the credit rating agencies don't care about their reputation. The issuers don't care about their reputation. We have all these SEC regulations that say, look, if you're a bank, you're an insurance company, you are a money market mutual fund, a broker-dealer firm for capital purposes, you got to get this stuff rated or you can't own it. So it's like having a driver's license now. And the reputation's gone completely out of the equation. That's another way in which regulation is antithetical to the economic motivations and incentives that firms might have to build their own reputations.
So what do we, I don't know if I totally agree with you on the scaling back of the regulations, but
why should you be different from anyone else, Mike?
But so what do we do about it? And by the way, are there any good firms out there with good reputations on Wall Street?
Well, that's a very good question. So the answer is that now I think a lot of people don't trust regulation anymore. And so firms now, in order to attract the business of the people who don't believe in reputation, the people who don't believe in regulation, the people who don't think that they themselves are rocket scientists to figure out all this stuff, firms have to, there's an economic incentive again now after the SEC's fallen into disrepute for firms to invest in their own reputations. And we saw something very significant in the last couple months with Morgan Stanley. I don't know if you saw this, but the folks there, the management there, changed the way that their traders and investment bankers are compensated to get away from the huge end-of-the-year cash bonus, and they're now paying these bonuses out over time, and they're saying that if these deals you're doing with your customers go sour, you're not going to get your bonus. That these deals have to stand up for more than a week and a half after you book the trade. That is clearly...
That's going to put Morgan Stanley out of business.
Well, I don't think it will. I think I think that people will go to them and they'll say, if my broker really is leaving Morgan Stanley to go to Goldman because they really are so focused on this fast money, I don't want to do business with them. That I think that you have to look at, they're going to lose a few good traders, they're going to gain a lot of customers, and the traders that remain are the ones they want to keep. I mean, this is my hypothesis. We'll see how it works out.
Yeah. Anyway, fascinating book. I'm going to put it up here. The Death of Corporate Reputation. Jonathan R. Macey. Jonathan, thank you very much for coming on the show. I really appreciate it.
Thanks so much for having me.
That's it for now, folks. This is Mike Norman saying, see you next time. Bye-bye.